section of UCL. And yes, and in the last year we started to kind of to test the product, and we did it with Nitin and Navadan. And so why anthropology? I mean, we have, there is quite a lot of work on an anthropology of debt and on credit cultures. And I'm not an expert actually on the kind of financial inclusion, but I started to learn about financial inclusion in the field, doing long-term field work in North India and across South Asia, both myself as in projects with other team members. And then kind of we realized to kind of use this material to try to think out more experimentally about how to kind of try to develop a new kind of fintech product, which is more centered on the client perspective. So debt is an issue that is never merely economic, but is also deeply moral and ineradicably social as well. So our research on predatory economies and loan shark practices in South Asia and beyond shows that a large sector of the population remains still unbanked or underserved. And in particular, they are excluded from affordable financial services. And we know yet that from our research as well that there are thousands of people in this sector that actually they are credit worth, but that they can prove their financial solvency because they do not have any formal credit histories or collaterals or live in kind of no-go areas where financial institutions prefer not to operate because of corruption or criminal economies. So also for us it was quite important to develop a tool which allows us to measure impact. And the product that was thought at the beginning in particular for the social lending sector. So in the social lending sector there is quite problems, still quite problematic to have kind of benchmark data from which then to measure impact. And as well has to have a product that included some forms of literacy training. So what we have in mind is, so our challenge has been to create a scoring tool which demonstrates the credit worthiness in spite of absence of financial data or with minimal financial data, and as well as to track impact. A product built thinking about the protection of the client, both in the financial and in social terms. We did that starting from what we know best, and namely the local social cultural understanding of financial risk. In sum, we put into practice what we learned from doing long-term anthropological fieldwork with money lenders, informal money lenders and their clients. As a result, our product builds on the assumption that not only financial data, but also socio-cultural data are crucial to assess risk. And so our methodology and the algorithm is based on this ethnographic knowledge. And I can go more in detail than in the discussion about how we use ethnography and anthropological understanding of debt cultures in our indicators and for our app. So, for example, eDRAF, in the case of India, take into account the specificity of the Indian joint extended families and evaluate credit worthiness of the family and its network, not of the single individual. As well as we kind of been, we've been kind of mapping the local political and moral economy of debt, understanding what is supposed to be good debt or bad debt, the material and emotional dimension of debt, And also, what we learn in the field is that it is not being credit worth, which is bad, but not getting in debt. Of course, there are also kind of set of honor and moral obligations, the temporality of debts, and gender and kinship issues. Question from this field, actually, that still puzzled me was actually, why do people pay rather than not pay in this segment? And I really think that this seems the question to answer rather than why people do not pay. And one thing that I think there is quite not so much emphasis there is quite a lot of emphasis on giving people credit, but not much is known about how credit is then collected and which are the practices of debt collectors, which could be quite also coercive. And this leads me to kind of understanding, inclusion. What do we mean with inclusion when we talk about financial inclusion? And what are the social costs as well of financial inclusion? For example, the risk of becoming over-indebtedness, or through creating new kind of vulnerabilities, and basically having a digital economy which in a way reinforces traditional patterns of dependence and extraction. And so I think the questions for us is very much how to provide credit with an affordable interest, and what is an affordable interest. As I said, and now we are kind of collecting evidence on the robustness of the our tool, and we are testing it in the field, and with Navadan we started to do some work, and it's still very much a work in process. We're assessing the demand for this tool from various financial institutions. And importantly as well, I think that in India, and also from being here from yesterday, and this is my first financial inclusion summit that I attend, they're really far ahead of the curve, in the sense that there are quite a lot of lessons that can be taken from India to be kind of exported and used in other settings. And we are thinking to tailor now the tool to some markets in Africa and as well in Europe, like in Italy and UK. So this will be the kind of next challenge that hopefully with Nitin and Navadam we'll try to kind of have. And yes, I think we are here to kind of learn and to kind of see, discuss more the possibility of developing this type of alternative tools. And I think we are... Yeah, no, I just finished actually, so it just came at the right moment. So I'm kind of looking forward to the discussions, and I leave it to Nitin. Thanks.
Thank you so much, Lucia. That was interesting, and very happy to see a lot of hard work put in field by Tommaso and some of the other team members, finally culminating into some conclusions. And very happy to see that some of the conclusions that you guys are drawing out of Indian landscape would perhaps find resonance in other parts of the world, including Eastern European countries and West of Africa. So really looking forward to the next leg of study. Having said that, I'm happy to have a great panel around, but before we start clocking, I think most of these gentlemen and the two ladies here are known to the system, so I'll not go into details of introducing them, right away jump into questions, but my request would be also to kind of introduce your organization and your key agenda with respect to the topic on hand as we go along speaking. So we've been given a very interesting topic as well. We're talking about alternative credit assessment within the inclusive digital lending space. A lot has been said, a lot has been done in this space. There are multiple schools of thoughts and conflicting opinions as well. So maybe this would be a good time to kind of consolidate and summarize some of those opinions. I have a great panel of people who are traditional practitioners who are trying to move towards implementing digitization and automation, and also people who are approaching it from a tech-first lens, who are trying to get and address the same segment in a different manner. And of course, people who have advantage of research, gender, as well as investing and lending, looking at the space. So without getting into too much of elaboration, I'd request Vivek ji to start the proceedings. And Vivek ji, while you introduce yourselves and your organization, would be interesting to know what kind of initiatives your organization has taken on the automation and digitization side.
Thank you. Thank you so much, sir. Good morning, everybody. Satya is a new age microfinance institution. We call ourselves as a PhysiTech model, where it is based on touch and technology. In all our designing, it is traditional with human touch. But we have used technology for data accuracy, for credit assessment, to understand our customers much better. And we are just 6-7 years old, and almost 7 years old. And in last 7 years, we have reached almost 2 million households in 25 states of India, with a team of almost 7,000 people. And it was never possible. It is one of the fastest microfinance journey all across the globe, whatever we have achieved in last 6-7 years. And it was only possible because of having a digital approach in terms of our designing. We are having almost paperless and cashless operations. Sometimes people ask that whether this technology is going to bring efficiency. My answer is it is not about the efficiency at this particular time, but it is accuracy in your decision making, accuracy of your data, and reducing your TAT at some point, at some extent. And it is an investment in first 3-4 years. But after some point of time, the leverage is there. So in this way, the Satya is designed. And from day one, the approach was because our journey started just before the demonetization. So digitization was forced to be adopted for us, and we were very new. And from 1st January 17, when we started our journey, the first agenda which was discussed among the team of that particular time, some 50 people, it was that we should have paperless and cashless operations. And today or tomorrow, cash will not be the king of the India. And the first step should be how we should select our customers where digital disbursements are possible. My team was quite resistant. It was not a model at that particular time. But luckily, 1.5 years before, Jan Dhan accounts were very much popular, and it was opened almost 40 crore Jan Dhan accounts were opened. And my understanding was that anyone who is not having a bank account is not bankable in today's time. Means if with too much push, government has even taken a decision of going to demonetization, it means they are very confident that Jan Dhan accounts are opened and everyone has access to banks now. And we should utilize this opportunity, and it is just a mindset, it is just a thought process, and anyone who is not having a bank account, he or she should not be our customer at this particular time. We can assist them. Sure. From there, this journey started, and gradually, as of now, we are having almost 92% digital collections, 100% digital onboarding. It is almost paperless in terms of having e-sign, e-KYCs, and whatever the best practices are there. Means, as a company, we say that we don't innovate anything. We just adopt whatever is best available in the market. And we don't hesitate in saying that. We are not a technology company. We are not an IT company. what is happening, we should be open for adaptation. Thank you.
No, clearly, thank you so much for those inputs. And it takes a lot to admit that you're not innovating but using technology. And clearly attributing a lot of your growth to the fact that you adopted digital means is also incredible. So congratulations on that. Let me just switch gears to now a tech-first kind of an approach to the market and move to Puneet. So Puneet is a co-founder of Kaleidofin. More from him.
Very good morning. I'm Puneet. Very, very interesting question here in terms of how do you start to use tech first in building this out. I think that we are at a very interesting juncture. India has had a very large number of microfinance customers. We have a very enabling system in the form of priority sector lending available. We know that therefore there is an interest to be able to make investments in this space. The challenge though is that we still need to graduate to creating models for underwriting customers. A lot of the growth that we've seen right now has been process-based growth where we form a joint liability group. And there is a very, very large reliance on that group basically getting the customers to pay, followed by superlative collections. And I think that's basically where also we as a country have become very data rich. Because of credit bureaus, we have now several years of credit history of customers, and the overall data availability for this customer segment today is improving. We have some data on banks, and now when you start to look at all of this data, and you start to now look at an individual as opposed to being a group, there are lots of possibilities that start to open up. Quickly, just talking about some of the work that we've done, Chi-Score has already been used to underwrite over 18,000 crores in loans. And this is a number that is now growing by 1,500 to 2,000 crores on a month-on-month basis. And this has all kind of happened at delinquency rates which have never really exceeded 2%, even in the COVID scenario, where delinquencies had actually increased dramatically. What is also very, very exciting as we start to look at some of this is that the rejection rates have fallen very sharply. What we found is that given the various requirements that were coming in, and especially if you just look at indicators such as has the customer borrowed 2 loans or has the customer been in delinquency over the last 90 days, when you start to use some of these very basic rules, the delinquency starts to suddenly jump up to 30%, the elimination of customers starts to jump up to 30%, 40%. And I think that's the place where scoring models can help a lot. We've been able to get to rejection rates which are getting closer and closer to single-digit numbers, yet maintaining a much higher level of repayment on loan sizes, which typically are 3x of microfinance loan sizes, so which becomes extremely interesting for customers who are graduating, who are wanting to move up the ladder in terms of getting towards an enterprise loan on their own account. So I would say, as we start to look at it, once you have a very, very strong underwriting model in place, you then design your collections on the basis of the fact that you have a very strong underwriting model, and you don't start to design on the basis of saying that collections are going to drive my entire business. So to that extent, it allows you to be able to build for a much larger geography. It allows you to be able to scale much faster. And I can tell you, I've run a physical organization in the past. We did not get to 18,000 crores in 2 years of launching anything at all. And that has really been made possible through the digital first approach.
Interesting and very different perspective. Now let me bring in the perspective of a bulk lender. So as you all know, Northern Arc has been one of the leading lenders in this space, in inclusive finance space. So I'd request Ashish to quickly introduce himself, the company, and what have you done on the alternative credit side?
Sure. Thank you. Good morning, everyone. Delighted to be here. Very interesting conversation sets. First, the Northern Arc was set up about 15 years ago with an objective to flow, the seamless flow of credit for the people who need credit to the people who are willing to invest. And over a journey, we would have moved around 1.5 trillion INR of credit and impacted over 80 million's life. Fair to say close to 5.5–6% of India population would have been impacted directly or indirectly through Northern Arc ability to lend, manage funds, and to find placements. Clearly, the big part is of this journey for us to what we've accomplished is a function of two things. We are essentially a data and a digital company. The entire transaction, whether it's a single loan or it's a PTC or a securitization, everything passed through our own tech stacks and passed through our own risk models. We run about 30 plus scorecards. And the interesting part of our scorecards, they're designed to be far more inclusive. So we don't differentiate between age, employment, gender, and all of that. And that enables us to get a significantly better risk outcomes and which has been tested over the last 10 to 15 years through the credit cycle and come with probably the best in the industry cost of credit. And that approach enabled us to ensure that across these sectors where we work, whether it's microfinance, MSME, vehicle finance, affordable housing, climate and renewable, all of these 7 sectors where we focus, we are able to contribute far more effectively for the flow of credit. And that's the value we not only see to the way we commit to our originating partners, but also to our investors, for them to see the quality of outcomes for the investments they are making. And that differentiation reflect and our commitment for flow of that credit. We've now also launched our own 2 big platforms. One is a new score, which is essentially inclusive, very, very inclusive score designed to get large number of NTC and to get a better risk outcomes, which both a lot of large originators and investors have begun to use, essentially helping them with 4 simple questions, which is whom to lend, how much to lend, what price to lend, and what will be the probability of default. Essentially help crystallize the risk policy into the execution framework, and which comes in because we've had over 40 million time series of loan performance data, which we've seen, and be able to build models using that learning which we had. And similarly, the entire tech stack for on-lending and co-lending, those are 2 big pieces. We do about 30 to 40,000 loans a day, which are real-time underwritten, attested, credit score and disbursed 24 hours a day, 365 days a year. I think that's our commitment. We stay very close to our purpose, and that is essentially to ensure the flow of credit and driving the financial inclusion. Yeah, that's all. Thanks.
Incredible numbers, I must say. And it's very heartening to see that bulk lenders are also starting to adopt alternative.
Please do not use term bulk lender.
Sure,
We call
my
ourselves
apologies.
intermediate financiers.
Intermediate financiers.
And we
I stand
both
corrected.
lend directly and to lend as an intermediate. So bulk
I
is not a good term.
Sure, I stand corrected. Intermediary lenders. I wasn't familiar with the term, must say. Interesting term. Being a banker, so we've always understood size as a parameter, so maybe stand corrected. But since 3 different types of entities are talking about using technology, one speaking about how to use technology to drive efficiency, one speaking about taking tech-first approach and therefore recording large numbers, one talking about different structures and more sounding like a factory setup, efficient. Maybe bring in some of the attributes that one could be failing on while doing these processes. So I may request Swati to tell us what could be some of the biases that may come up in such scenarios, if you may.
Thank you, Nitin. Am I audible? I'm Swati. I'm a part of Women's World Banking. Women's World Banking is an international not-for-profit. We work on gender and financial inclusion and are focused on providing close to 1 billion, with the aim of providing 1 billion women who across the world who are unbanked or underbanked tools of economic empowerment. So to just give that perspective, we work through financial service providers. And to come to your point on unconscious biases, so I mean, the most important thing here is the word unconscious. As lenders, as people who are working in the sector, we try to be inclusive, and that's the word I've heard many times since the morning. Now, this unconscious bias can creep in at any point of time. So when you look at the lending operations end to end, it starts from the time that there's an acquisition, then there is an assessment, there's a servicing. So throughout this, the process, various biases could occur. And as we So we at Women's World Banking undertook a project where we looked at lenders, not digital lenders, not just in India, but also in Mexico and Colombia, and found that while our algorithms might be, we try and train them the best that we can, but when the representation of women is lower, sometimes the data that we have is not enough to train the algorithm. But having said that, a lot of us still have hybrid processes, and there are, even at the point of acquisition, some biases that creep in because of the subjective nature. And I was talking to Puneet this morning about, and he was sharing how if you, at the first point of interaction, if you remove that subjective bias, there is a greater proportion of people who are new to credit who do get credit. So here I wanted to just quote the work that we did with a Mexican lender. It was Banco Azteca, and there where we looked at the biases. So the whole process is that you look at what biases could occur, what is the magnitude of biases, and then you move to mitigate them. And here we found that the women at the top of the funnel, because of some subjective decisions, what was happening, there was a very high proportion of false negatives, which essentially meant that and it was higher for women. So it basically meant that these women had the propensity to pay, but were getting rejected. And just by altering the algorithm and rules a little bit, what it enabled the organization to do is to increase their portfolio by 8.5% without any increase in the cost of acquisition and breaching any of the threshold portfolios, any thresholds of the portfolio quality. And so essentially, there's a large business case where we, as we look at these biases in various operations, in our entire end-to-end operations, and then we can progressively solve for, at various stages, how can we improve the gender balance and how it leads to a better business case for the untapped opportunity for the business.
Interesting. So you're talking about expanding the funnel, reducing biases. So I think that's something when we start using technology, one needs to be conscious of that there would be things which data will not speak, and there would be intentions that we would want the data to behave with. So very interesting perspective. May I now request Ashwin to pitch in. Ashwin, so you're hearing so many diverse views, diverse types of practices. What's the future going to look like? Where do you see most attractiveness? As an investor, what are the spaces you think which are going to give you, quote unquote, best returns, and therefore would be areas of your interest to invest in?
Thanks. My name is Ashwin Chadda. I run a fund called Anicut Capital. We are investors in financial services, amongst other sectors in India, and we run both debt and equity businesses. The debt business is now 8 years old, and the equity business is 3 or 4 years old. We've been investing in financial services in India for the last now 20 years in our personal capacities. We've funded companies that are more traditional lenders and also done some tech-enabled lenders as well. So we've seen the journey from, I still remember, where we were fully dependent on branch-based growth. There was no concept of a disbursement happening other than cash in many of our initial companies. And now we've transformed to backing companies where having any sort of paper is a bad thing. So it's fully digital. So we've seen all of those transitions happening, and it's heartening to see some of the largest lenders and companies here also talk about using technology to streamline their operations, and everybody is now, whether you like it or not, you have to be, any organization, whether it's financial services or otherwise, have a technology strategy, and so I think it's very important. I think we're seeing more and more focus on that. It's a discussion that is we hear more on the boardrooms now. So at the same time, you know, the ABCs of lending are still haven't changed over centuries. So, you know, it's important to marry the two, is our view. And I think the best companies are the ones which will be most efficiently use data as well as, you know, the traditional banking norms to come up with processes for the next 8-10 years. So that's our view.
Wonderful. So the investor is speaking about marrying the traditional with the modern. That's interesting. Let me bring in Amitesh ji and ask him, in this journey, of course, you've also seen a journey towards digitization. What have been some of the challenges that you have encountered? What practically works? What hasn't worked? What could work in future which hasn't worked so far?
So thank you, Nitin. Very good morning. It's really a pleasure to be here with all great panelists. So I'm Amitesh Kumar. I'm Chief Operating Officer and CFO of Midland Microfin. Midland Microfin is basically a Jalandhar headquarter. We are a Punjab-based microfinance institution now present in 13 North Indian and Eastern states. And we are having close to 8.5 lakh of customer base, close to 2,700 crore of AUM, 4,000 staff. And I, along with our promoter, Mr. Amardeep Singh Samra, we started this institution in 2011 after this AP crisis. And we transformed our institution from paper pen kind of loan disbursement to paperless kind of environment. So we have seen all those journeys, and what we realize is that for customers, digital adoption is still a big challenge because we feel that digital literacy is still a kind of challenge at root level. So when we transformed our institution and we realized after demonetization that why digitization is important, because each one of us as MFI had burned our fingers because at the time the automation and digitization was progressing, but not majority of the institution have adopted digitization wholly. So we have probably had huge challenges, and then there was a key learning that each one of us should start dispersing loan at least in bank accounts. So that was a great learning, and eventually with all efforts at industry level, the entire industry is now able to do that disbursement in bank account. That was a great, I think, kind of achievements we as industry has done. But as far as digital repayment is concerned, I think we still are struggling. We claim that we are completely cashless, but it's a assisted model. It's not a completely cashless. Customers, if they directly pay to a bank account of concerned MFI, then I think it is a kind of model which we all are eyeing it. Now, whatever cashless journey in terms of repayment we have achieved, it is basically a assisted model wherein we, with the help of CMS companies, cash management companies, we are bringing intermediaries and bringing back collections. So I think digital literacy is still a challenge. Second thing, I feel that trust among customers is a challenge. If we all know that if in any villages, if a lady is being ditched or be frauded by some people, then I think entire village, they are skeptical to make digital payments. So I think a lot of digital literacy, a lot of, I think, ground level financial literacy, and the entire ecosystem has to play a huge role in case of doing transformation at root level.
Very interesting point. So digital penetration, digital literacy, some pieces worked, some didn't, but you're sounding very hopeful that things will work in future. Tommaso, may I bring you in? You went to the field and met the customers in rural areas. How was your feeling? Did you think that gathering so much data, so we're all relying on data. There is a lot of low frequency data which we try to increase frequency of, but you still need a lot of personalization. Swati spoke about increasing the size of the funnel at the top. How difficult and how tiresome do you think gathering that information is? And do you think there is resistance on ground on sharing too much data?
Okay, thank you very much for the question. Thank you to be here. It's an honor. And yeah, I take advantage of the question also to explain a little bit better maybe how the app works. So yes, first of all, as far as I know, I'm an anthropologist, so it's the first time, like Lucia, that we find in this kind of context. And it looks to me that inclusive here means mostly to be included within the game of financial loans and be banked. So mostly getting a bank account and so be able to be inserted in the game. So in a social sciences terms, this is maybe a little bit reductive. Like for us, inclusive means also to be inserted in a way that allows the person, the subject, to be able also to deal with it in a proper way, no? So not always just to bank people means to include them, because maybe they don't know what to do then with the bank account. Maybe they become also prayers to deep situation they cannot handle, no? So this app was thought exactly in order not only to allow people who are unbanked or are not financialized to be able to get a loan, but also to do other things. One of them is, of course, to be educated financially. So the process is to go in the field with this tool and to make at least 2 interviews. So, of course, it's demanding, is a costly process. So I understand that in this situation may be seen as something that is not worth doing because you need to be quite fast in deciding whether a person is eligible or not for a loan. But this is how we understand the inclusivity, you know, to have the time, take the time in order to do something which is not just let the people within the game, but also to offer them with the tools to improve their situation. So you go to the field 2 times, you collect data, not just about the person, about the financial situation, the formal financial situation, but about the family, because people are embedded within social relations, and in India this is very true. And even if this kind of financialization, the microcredit and so on, often do what in anthropology we call individualization. So they try to detach people also from the social networks, which sometimes is good, of course, because it allows people not to be too much within, no? People that maybe that can pressure them, relatives and neighbors and so on. But often people are embedded within these relations, and sometimes even when they are in difficulty to pay loans, they then have to rely on these social networks. So, so we understand how the family, mostly, the financial situation of the family, about salaries, about ownings of lands, animals, whatever, their networks, we understand whether they're already loans and so on. And after 2 interviews, we do also the business plan about what they will do with the loan that they get, if they get it. And in that process, they also learn what is a budget, what is a family budget, what is a business plan. So it's a way really to educate financially people. So of course, it's costly. It's a lot of data, which are mostly qualitative data rather than quantitative one and just financial one. But it's a process that, as we have done it a lot of times, it's really fruitful, I think, and it really takes to something, and I think that it worth the time that is spent, because it really produces a knowledge which is extremely useful to do that kind of inclusiveness that we deem to be the ethically most appropriate. So it's really a social enterprise rather than, so I hope they have.
Sure. So you're saying that primary data collection is very expensive, and sometimes we actually need to educate the customer in terms of what we mean by that question and what is the kind of expectation in terms of responses to that data. Lucia, may I bring you in? So you saw the Indian market space. You've had the vantage of seeing other markets as well. This topic of inclusive digital finance, and where one could use alternative data for underwriting and for providing services, how do you see its application? Is this very similar in other places in the world? How do you see this?
Thanks, Nitin. I think that, of course, there is, we see it. I'm doing a lot of comparative work across Europe, South Asia, Latin America, in Africa. Sorry. And and of course, we developed this tool for thinking about India, but now we see that there are a large possibility. I mean, even in Italy, for example, there are a lot of people, immigrants, refugees, that they don't have access to credit, but they have the capacity to pay. So there kind of be ways in which to kind of bring them in, into the field, as well as in UK. I mean, there is a large informal economy also there, even if people don't speak much about that. But there is a lot of people don't have access to credit, they are ready, they have the money to pay back, and they could benefit with some form of alternative credit risk assessments. And of course, the African market as well. I mean, of course, Kenya is quite mature because they did quite a lot of stuff, but Nigeria. But I could see that things are much more developed here in terms of technology, in terms of thinking, in terms of the products that you're offering, and the type of data that you're also using. And the experimentation here has been quite fruitful for the last 10, 20 years. And I suppose that you have also quite, in India, the IT service and the IT capacity is big, and of course that helps to push. This is not the case in other places in the world. So I mean, this is a big advantage, And here I think you have thought creatively about it, quite, And I think that there is certainly the possibility of using this knowledge to create tools that go from the global south to the global north, and or from the different places in the global south. This is how I see it. Yeah.
Since we're talking about credit and expanding credit, I think one of the dimensions of credit, and Swati did mention this, is about expanding the top of the funnel. So while a lot of people do not qualify on the credit filters, is there an opportunity to use some tools to expand the filters and still make it viable for the practitioners? Maybe Ashish, Swati, maybe I'd request you guys to pitch in. Is there any role that the credit guarantees could play in the space where one could expand?
Yeah, I think both. One, when we've been talking a little about data and we're talking about risk models. And I mentioned earlier, all our risk models are very inclusive in nature. Essentially do not differentiate between new to credit and credit, or the age, or the gig worker versus a permanent employee, or all of this conventional underwriting model. And that means we are able to get large number of population through the door in both these categories. Really help. Coupled with, for us to not only data and the risk models we are building, but we are also willing to participate in most of the cases with skin in the game, and what we call it, take an A2 risk or a credit guarantee on the pools which we securitize or which we sell to investors. And that essentially makes it far more, especially the large number of multilaterals who wanting to come and invest in India, that becomes a very important element. And to my mind, if that entire ecosystem needs to work, this means from the origination of credit to the sensing of credit, and that's the commitment. First need to demonstrate that we are able to add value in the journey. And that could happen both from tech, data, credit guarantee, and the alternate servicing. Big piece, which every investor looks at it saying, what's an alternate servicing model? And that's another stuff we are working towards to say, listen, as long as we are taking the paper to you, we will be an alternate servicer. We're also incubating a new, potentially a guarantee company to ensure we are able to work on that journey to provide. But I think both building a challenger risk models, which essentially are inclusive and do not differentiate between new to credit and people with credit history. All of us will talk to you about data and tell you the bureau scores may or may not rank order and stuff like that. That's the one, supported by your ability and having the confidence to have skin in the game. Listen, if we have predicted the model, I'm willing to participate with skin in the game in that pool, what's been brought up to create liquidity. I think both of those are two big pieces to expand the funnel. Yeah.
Helpful, Swati.
So I'll stick with the credit guarantees. So credit guarantees, if you see, and specifically in the Indian context, there are many credit guarantees that are available, but let's look at the sovereign credit guarantees or the government credit guarantees. Now, what is the single largest measure of success of a credit guarantee? And talking about expanding the net is the credit additionality that it brings. In the absence of that guarantee, would that credit be actually given? So that, I would say, from a sector, from a customer point of view. But from a lender point of view, now if I have to really use the credit guarantee, is it predictable? Is it on tap? So that I know, for want of a better word, is it for real? Does it, is it only a construct of a financial instrument? And I feel that is the place with technology, there have been efficiencies in the processes. There's been feedback of the sector that has been built in. Is it 100% there? The answer, the jury's still out. But I think the most heartening thing is that we are working towards that in terms of increasing the coverage, in terms of ensuring that the cost is affordable, both in terms of looking at processes, both in terms of issuance, so it's easy to get the approval, to get it at any given point of time, but equally important is the settlement piece of it, because that then becomes key for the lender, specifically also because a guarantee is always back-ended, which essentially means that you have to provide for it. And as long as we work towards making sure that both these processes work for the customer, but equally important for the lender, there is greater confidence in the guarantee, and it will lead to additionality. And actually, the guarantee, the sovereign guarantees in India are, like a lot of other things, the largest in the world, and the additionality is slowly being proven. And I'm hoping that next year we will have more data and we'll be able to say it more convincingly.
Essentially collections data, right? The issue is alternative credit data. But having said that, Puneet, why don't you bring in your perspective? So alternative credit, data around it, credit guarantees, learnings from what people have done in the other markets, not just in inclusive finance space. If you could just reflect a bit on those.
A very wide question. I'll try to break it down into a few components. So first, just in terms of improving the funnel using data or alternate credit data. And I would say that that's been one thing where we've found that data can add a lot of value. Today, what we've started to see is most entities have a scorecard or a business rules engine where you start by saying, I will reject everybody with a credit score or CIBIL score or Equifax score or whatever, which is below, let's say, 600, 550, 750, depending on what the organization type is. And in the process, you actually already start to lose out a very large chunk of people. And then when you add another filter to say that if you have more than 3 loans, I'll reject you. But I can actually put to you a customer who may have taken 5 loans, has never defaulted in 7 years. But the problem is the moment you include that rule to say not more than 3 loans, you've actually forgotten the fact that this customer has already been paying these loans on time. I also know of a customer, for example, who was in default 22 months ago. This person skipped 1 installment. After that, this person paid every single installment in time. The credit bureau actually showed that this person was in par 30 for the last 22 months, which is actually accurate. But because of that, this person's credit bureau information was so bad that this person was not a lendable person. However, the person has spectacular payment track record. 1 payment delayed, and once the loan gets completed in terms of its 24-month cycle, the customer would be actually back on track. Now, the problem is that the moment you start to look at rules engine, you eliminate a lot more customers. And I think that's the place where when you start to counterbalance negative information about a customer with some other positive information about the customer, you actually start to reduce rejection rates. Cost of customer acquisition today is one of the biggest costs. It's actually, I would argue with you, it's actually more than the cost of credit risk that most organizations face. And we as an organization have been able to drop out rejection rates from 40-45% to something around 10 to 12 to 14%. That's actually 26% on 60% acceptance rates. That actually is like 40% higher throughput for no extra cost at all. And it becomes more inclusive at the same time. And I'm still not talking about alternate data here. I'm still talking about just very basic data available from credit information bureaus. Alternate data, I think we have a lot to learn from. And I would actually not immediately jump into it and say that by looking at customers' mobile phone records and others, you can straight away write much better credit risks. And I would say that, yes, it adds to models in certain cases. However, the first step gets to saying that what is the missing information that I have about the customer, which is currently stopping me from lending to this particular customer. And I think some of those fill in the blanks can be actually done very, very well with alternate data. I also want to touch upon this next step in terms of just purely looking at how do we look at inclusive sector versus non-inclusive sector differently. And I would basically say that the big issue that we have in the inclusive lending space, and largely with low-income informal sector customers, is that the only real transaction data available to us is the credit bureau data and the trade lines there. The bank account information is coming in, it's not being used as much, which is very different from what you see the moment you move away from the financial inclusion space. You have a lot more GST information, you have a lot more transaction information, and you start to actually underwrite loans on the basis of significantly more information. However, behavioral information about the customer is not available. And I think that's the place where alternate models like what Lucia was talking about perhaps can start to come into play. In our customer segment, in the inclusive finance customer segment space, I can actually tell you that transaction data that you have in credit bureau, in many cases, becomes a very good predictor of behavioral aspects of a customer. We've actually taken Chi-Score now international. We're working in Bangladesh, we're working in Nigeria, we're working in Kenya. We've actually started to build models in each of these 3 places. And I can tell you, we in India are blessed with the kind of information that we have from a credit bureau space. When you compare it to some of these markets, I would say that we have right now a treasure trove of information. And then last thing that I would like to say is that data is not a panacea to everything else. What we have today, the repayment track record that we have, is for microfinance companies who have spectacular collection ability. When I say that we are a data-first organization, if you suddenly now take away that elaborate collection and say that just use this data, this is a great customer, lend to this customer, the moment you change the rules of the game for the customer, where the collections suddenly change, the repayment rate could be very, very different. I actually see today that use of good data can actually start to reduce rejection rates. It can actually make it much more inclusive. It can help us increase lending to the customer, as opposed to it replacing the superstructure of collections. And I would say that will need to continue till we are largely a cash economy. And I'm going to stop here.
Very interesting. Vivekji, let me come back to you. Where are we going? Where are we headed? You've had a spectacular journey, but give us a little bit of a crystal gaze. 5 years from now, where do you see all this converging? How much do you think would be the role of alternative credit? Let me also just add a caveat there. Are we too fussed about credit? Is there an opportunity to do more than credit? Micro savings, micro investments. Where do you see this market going?
I think I am firm believer of that microfinance industry has not utilized its capacities yet in totality. Generally, we think about just lending to the customer, one person in the family, and coming back. And servicing of the loans are there where we are visiting the villages almost 52 times or 25 times if bi-weekly, or 12 to 13 times if it is monthly. In that case, means still the cross-selling of other financial products and designing products beyond micro loans, that is a greater opportunity for all of us. And with more data, with more digitization, and with the integration of all the data of the family at some point of time, we can increase our offerings and we can offer better products to the customers, which on one side we can say that the microfinance group lending is the place where the inclusion is there, and there is upward journey is there to individual loan, micro business loan, LAP, affordable housing. That can be the area where the a particular customer is upgrading in his or her life cycle. On the other cycle, for the families, the education loan can be another one. The upgradation in the skill loan of their husband or son who are working in different sectors, that can be another area to support their lives in a different way. And because we develop a lot of trust and relationship with the families with whom we are working, so we can leverage that to any extent, and technology will be the key enabler in reaching out the untapped market, but also in the penetrated geographies, the product innovations are the key, where I think that the microfinance network has been least utilized yet, and that potential is tremendous. And as a sector, we can only bring our operating cost down, and we can be more sustainable, profitable, and risk-free by using the additional markets and additional opportunities in the families.
Nitesh ji, आपका क्या विचार है? What do you think about this?
So I think with the recent regulation in place for microfinance institution now, any loan which is going into the household and with an annual income of less than 3 lakh is, I think now we can only do. I think we can't do a bit of innovation now on other piece. So we have to innovate on our product innovations. Since last 1 decade, if we see the microfinance journey, we have seen that there are a lot of pilots have already been done for a lot of other products, whether it's an education loan product, whether it's a health insurance product, a lot of other products, but not every product had scaled up because of its limitation or challenges. Now we see, I personally see that I think there is a great opportunity now lying going forward to cater and to meet the needs of these kind of products, right? So I think in coming few years, education loan product and health insurance, 2 kind of products, and including I think some product-based loans. I think 2-3 kind of product innovations will take place in near future, and I think now we all are compelled to meet the diverse need and aspiration of customers of that household, which we are now I think tagged by a regulator to do the needful. Yeah, so that's my views. Yeah.
Great. Ashwin, may I bring you in? Where do you think the next hottest startup in inclusive finance is going to come from?
I wish I knew. You know, it's very interesting. I think I've been listening to all these discussions here. You know, I think we often very hard on ourselves. I think the amount of revolution that technology has brought in India in credit and in financial services in general, you know, you look at UPI, ONDC now, is quite remarkable. I'll just give an example. Just a few months back, I had to make a $8 payment in the US. Some issue, I had to make $8. I used to live in the US, I have an account there. It took me $28 wire fees to send $8. Right? There was no other way to do this. And I'll give you another example. Last month I was in Sri Lanka. At the department store, I saw there was a Chinese person ahead of me. They used WeChat in Colombo to make a payment at the store. So, you know, I think payments are going to be the next leg for a lot of us. We're seeing already in the consumer side, payments have, everybody has a Paytm. We're wearing, you know, QR codes. That has really taken off because of the government's initiatives. But I think across businesses as well, I think we're going to see a revolution in payments. That will help not only as from credit perspective, but you know, things like micro saving, micro investments. Already we're talking about, SEBI's talking about doing a SIP where you can put, you know, just a few rupees every month. So I think there's a huge revolution there on the investment side. So there's not only credit, but so many other ways where I think technology is going to leapfrog and give access to people that, you know, didn't have access to these products. So I'm very excited about the next few years. I think we're doing a great job, and you know, it's thanks to all of you all on the stage and in the audience that have really helped get India to this level where, you know, I think we're decades ahead of some of the Western markets in terms of just the process where we were adopted.
Sure, no, that's interesting. So I'll open the floor to the audience for questions, so please keep your questions ready. But I'll just pose the last question now to Lucia, because Lucia, you're an anthropologist. You're not a financial services person. You look at all of this from an anthropologist's lens and from a vantage where you're looking at multiple such countries. What is your reflection on this conversation?
I mean, it's quite a lot of to take heed to be fair, and but I think that as I was trying to say before, and also what kind of Swati suggested, that there are quite a lot of biases in over technological approach, and sometimes it will be good to combine qualitative and technology, or kind of more to have that will reduce the biases and will also enlarge the market. So is something and to be more inclusive. So the challenge, I think, is that to how we kind of really combine all the type of digital data and kind of data, statistical data on financial data that are used now mainly for credit ratings, but keeping an eye as well on the qualitative life of that and what this can give us in terms of improving qualitatively the way in which we lend money to people, as well to avoid over-indebtedness, because that is also an issue, to not only to identify the people who to give credit, but also identify the people who to give credit is not a good idea, and that they will default. So, or they're gonna get over-indebted because they're gonna get another debt in order to pay your debt. So this is kind of change that we see, unfortunately, in the field quite a lot. And my question is, although, the informal market for money lending is still quite thriving. And my answer is, I don't know if there is any study on that. And why it's still thriving if there is so much kind of financial inclusion and so much products in the market. So I think that the next study I would like to do is to look at more at informal money lenders, Saukari, and kind of, and why they're still so successful. And we kind of go in the field and talk with them and ask them, do you have any problem in the, and they're not. And sometimes their interest rates are not as bad as some other, kind of technological companies offer them. So it's just some thought for, some feed from, some kind of thinking along the lines. But this is going on in my head.
So thank you. That was very helpful. Any questions, please? Shubhankarda, go ahead. Let me hazard it, and then I'll request some of my panelists to step in. Well, I think it's not so much a delta. It's also about how do we use data. Credit Bureau report you mentioned. So first of all, how rich is the Credit Bureau data? Because if the input is good, the output would be that much good. I can tell you from Navdhan's example that when we look at the Credit Bureau data, we typically pull a scrub into our data lake. We pull the whole data in the data lake, and then we have built an AI wrapper around it. So what we do is essentially first clean that data. For example, items like overdue markings are not accurate. Items like mentioning some loan as co-borrowed versus singly borrowed are not accurate. Sometimes the installment is mentioned, but the frequency of installment is not accurate. So I think more important is that you have the data. The data may not be necessarily very clean. How do you run scrubs on this? How do you build wrappers on this so that for scale, you can leverage that data better? Puneet spoke about scores. Scores is based on a certain set of matrices that the Credit Bureau itself has decided. How much of it can be challenged is a question. So some of the entities like us really do not use the scores. We use the data, we use the trade line information in the data and derives information out of that to underwrite the customers. But if you look at most of the scaled up organizations, they'll give their business rule engine, like some of the panelists mentioned here, to the bureaus, and whatever is filtered out of the business rule engine will get utilized. So I think the journey is to use it in toto, to clean it up first, use it more intelligently. So resources are there. In terms of alternate data, there aren't too many resources available yet. We are still relying on the credit bureau track records, collections track records, banking transactions. The hyperlocal matrices, for example, in which pin code are they operating, what crops are they growing, what has been the trends of those crops, what is the variation within a month, intra-month, intra-season, across seasons of those cash crops versus food grains versus oilseeds. But I'd request my panelists to step in on the question if they have any inputs.
I think let me try and bring the monkey in the room. I think the best way to look at it is to look at the evolution of the fintech and a consumer finance space in India. I know it's a little bit heated topic given the recent changes, regulatory framework. But if you actually look at it, between the fintech and a conventional lender, the delta is about 20 to 25%. And that's the population they're able to underwrite using the behavioral data or the mobile data, which is essentially not driven by the bureau or the trade performance data. I think that is a very powerful matrix to measure. We see that in millions and thousands of data when it flows through us, both in our on-lending and our direct exposure, because our thesis is, and that's why I told him that we're not a bulk lender. We essentially start with the credit policy of our lenders. And that is a very powerful delta which is coming through. So when you look at the mobile data or the flow of information or the mobile payment pattern, and a lot of these things gives you a much better indication of performance of credit than the bureau past track record can give. And the delta in the fintech world is about 20 to 25%. They're able to. We're comparing, if you put a pool of 100 applications between a conventionally underwritten piece and a new age underwritten, they will be able to get 20 to 25% better approval rate with the same kind of risk acceptance. So on a portfolio quality is a function of what's the risk appetite, but I'm saying risk adjusted basis, the spreads may remain the same.
I will discuss about our tool. First of all, I think that what emerged from the field is something that emerged also yesterday in the overall presentation, in which they say that the people earning from 1 lakh to 4 lakh per year, they repay 95.5%. So the default rate is really low. So this was the question also in the presentation by Lucia. Why the people pay back? Usually they pay back. I think that microcredit is striving in India also because of that, because poor people, they pay back. Also because in India, to be credit worthiness is fundamental. For the poor, it's fundamental to be able to get more credit, because otherwise they cannot go on. And this is mostly why the poor people, they pay back. So our tool, it works in different way. Like we provide a rating according to different, to an algorithm that take into account a lot of different things. But that rating can also be compared with the classical rating of all the innovative ratings. But the thing is that it is a social rating and also allows to understand vulnerability and whether the loan that is eventually given will improve the situation of the family of the person. So it's really a social tool that provides information about the financial capacity of the family, but in more qualitative terms, and then can be used along with other tools. But I think that it's really, it tries to do something more than just assess the credibility, but also to insert it within a more complex and more general landscape, and try to help families to actually improve in general terms the situation.
Any other questions, please? Yes, please.
Hello. Thank you for the discussion. This is Vaibhav from Belong. And I had a question on the qualitative data that was being discussed, and wanted to really know what kind of qualitative data is currently used in making assessments. Is it new data every time in terms of going to the field for each assessment for credit, or is there historical data that is being relied upon? And secondly, I think just wanted to ask that, given that the kind of investment and effort that was being talked about in collecting such data as well, what are the other kinds of applications or uses of this data that are possible, right? Both in terms of other products, like say insurance, credit, maybe investments, but also maybe in terms of organizational development, right? Capacity building, can it help with that? So those two parts, thank you.
I'm going to try to attempt this. Lots of different kinds of data is available, and in many cases, what we're also able to do is use transaction data to be able to infer other qualitative data. I can give you some instances of it. Let's say two MFIs are working in the same PIN code. The credit quality of one is different from another, and now you know that and they have common customers, because you can see it in the credit bureau record. And now you know that some of the factors can be mapped to either the loan officer or the entity and its processes, as opposed to customer itself. Then you can also infer some things. For example, India had a moment where we had demonetization. For the next 4 months, there was cash disruption. Now, some people did not default at all. Some people started to pay within 1 month. Some people started to pay after 90 days when cash situation became great. And some people paid, let's say, again in 90 days, but you also saw that they got a new loan from a different organization. Now, without even giving you a good sense, you can rank order these customers in terms of their repayment capacity. You can create a rank order of who's perhaps more liquid, who's perhaps more better, and you can start to infer a lot more qualitative dimensions of this. Okay. A lot of how you build models is all about rank ordering customers, and you can start to build a lot more models from the raw trade line data that you have from trade bureaus, like what Nitin was talking about. And it can start to give you lots of qualitative information about processes of organizations, which can go into training that you're talking about at the organization level. Some of this could also give you a sense that a particular customer always defaults in the month of October, is in delinquency for 2 months, and after that is always regular. Now that gives you a sense of how do you design a product to give you flexibility around October, because that's where the challenge is. So as you start to look at data, the point is that most people are not able to handle data easily, right? Once you start to look at data, it's actually your creativeness of how much you can do with it. And I would say that a lot of us are always also trying to figure out that somehow magically we'll have all the data in the world. And I can tell you that all of us in this room who are entrepreneurs at least are living because of the fact that there's information asymmetry. If all of us had perfect data, if all of us could have assessed every single customer in exactly the same manner, there was absolutely no need for us to run any of these businesses. Right? At the end of the day, data is never going to be perfect. There is always going to be somebody who's going to take a risk call to say that I am comfortable with the level of data that I have. At Kaleidofin, we are not only, for example, an analytics company which is giving out a specific chi-score. We, for instance, are always willing to say that we're willing to take a first loss or a second loss position on every single loan that we've underwritten. So we are confident about the fact that not only are we giving you a score, but if a risk happens, I'll take a hit on that particular. So it's just going to always be in that level.
And just wanted to add, build very briefly on Puneet's point, is also it's helpful to look at it from a portfolio point of view. When I spoke of the biases, essentially we looked at gender as a variable, but essentially you looked at the portfolio and saw, firstly assessed where the biases were. Then you looked at the magnitude and therefore the business opportunity that it represented, and you know, as Puneet said, took a call based on that, and rather I would say a calculated or a weighed call based on that. So the other thing, so we did speak about customer level, but also, you know, portfolio for various variables.
I'll just add by saying that what data we look at, what alternative data we look at, also reflects on the organization's culture. We've been dabbling with variety of data and variety of indicators. Sometimes when people work on a certain set of indicators, they get obsessed with it. They really, really want to find a judgment out of it. Not all data can give you judgment. I'll give you an example. We were looking at household expenses and the variation across, and some of our team members got obsessed with understanding electricity expenses, telephone expenses, transport expenses. Over a period of time, we realized that there is no trending actually. They're just force-fitting trends. Therefore, it's important to build modern organizations which want to rely on data, where they do not get over-obsessed with data. They're able to do a refresh, both on the data refresh in terms of choosing your indicators, as well as doing tech refresh. You know, the tech stacks are going to continue to change. There was a time when some of the today's largest, private sector banks were supposed to be tech leaders as well, which over a period has been occupied by startups. It's also important that while you look at alternative data, you look at data, you also look at the tech stack. Today, what is going to work is not going to work after 5 years, and therefore, every 2 years, we need to keep doing tech refresh. How many of us know that UIDAI server performance today is less than 60-65%? Because there is a need to continuously keep doing tech refresh. As the traffic increases, tech refresh is required. So I think the whole summary is that the culture that you're building for the organization is where it gives the highest amount of inputs. Are you going to continue to invest in this or not? Do you respect that kind of investment or not? Any other questions, if the forum may have? Yeah.
Good morning, Dipta Rag here from Ujjivan. I think the topic was really well covered. Thank you. It was a really interesting discussion. Quick question. As we talk about inclusive digital lending and building out model, can you throw some light from a customer's perspective, right? We all heard the organization's perspective that we want to do this because this is the next big thing. In the short term or even in the long term, do you see a divide coming in from a customer's perspective? Are all customers ready to actually go the digital way? If you
I think Damaso covered it a bit. May I request Amitesh ji or Vivek ji, you want to take that?
So yeah, in my previous communication also, I briefly mentioned that yes, there are a lot of things which are happening, are actually not reaching at ground level. The adoption rate at root level is really challenging. There are a lot of efforts. Essentially, it is required to educate customers, create awareness, to create a kind of model wherein we can, in villages, we can identify a few customers, a few members, we educate them, we train them, and they become an anchored lady who can propagate these learnings to the entire village. So I think adoption rate is, yes, challenging. A lot of efforts are being done. We as an institution, I can tell you our success stories is that in Jharkhand, what we have done is that we have came up with a concept of digital Didis. So we are identifying few anchored ladies from our centers, and we are doing one kind of workshop in our branches wherein there is a fixed content on digital literacy, and we are educating them, and we are ensuring them that they are aware, they are doing those transactions on real-time basis or not. So that boosts up their confidence, and then we take a kind of pledge and we motivate them to educate their center members, and they are propagating this knowledge to their customers. So in that way, we are doing a lot of efforts. I think, Tiwari ji, if you want to add something.
I think just one line. It is how institutions are prepared. Means mindset of the institution is more important than mindset of the customers. And if you and your team is quite motivated, customers are ready to adopt. And one thing is that we have to create trust, we have to create transparency, and we have to create that ownership. Something is happening wrong in digital transactions, at least on our side, we are responsible for that, and we can rectify it in least possible time. If some frauds are happening or something is happening, that grievance redressal is, mechanism is quite strong. That is the way rural India is emerging, the aspirations are emerging, the youth of rural India, I think they are the biggest hope, and nowadays the mobile penetration is almost a very significant level. The way WhatsApp and Facebook and other social media is used in rural India, and nowadays it was never in the past. In the last 4-5 years means we are seeing every day, even 14-15 years, young boys, they are using mobile phones much better than us. It means next 4-5 years will be quite, I'm not using the word challenging, but quite exciting. And we all are, if we have started thinking in that direction, it means we are solving the problems, and we all are thinking in the direction of digitization. And once, as a company, I told, we are dealing with almost 92% digital collections. It is almost 40% is from customer account to Satya account. That is one of the biggest achievement we have done in last 5 years, I can say that. It was only because there is a focus from each and every employee of the company. And we want to train our customers to do the digital transaction direct way. So that is my approach, means it may be person to person
Super
different,
helpful.
but my approach is that it is first the institution, first the management, then team, then your customers.
I think that's a beautiful note to close on. You know, with increasing digitization, penetration of smartphones, with better data connectivity and better utilization of data, I think things are only going to get better and brighter. On that note, let me thank all my panelists and the presenters. Very engaging conversation. Thank you so much for sparing time, and thank you so much, audience, for being so patient with us.
Thanks, Nitin. Thanks all the panel members for the insightful discussions. Great insights from field and experience. Thanks, audience. May I request you to come forward for a picture and kindly accept token of our appreciation.